if we get wage inflation and inflation is driven by wages, which it is happening, that's good for real estate. That means they can pay more in their apartment rents. They don't really care as much about the office rent. I mean, the shocking thing is in markets that have massive direct and indirect vacancy, like New York and San Francisco, and San Francisco is a basket case. Rents haven't fallen as much as you would have expected. And because tenants aren't really negotiating. They're just saying, okay, the rents are $50. They're not saying I'll take it to 30. They'll pay 48. Rents in headline rents, they say in New York are down 5%. That's a shocking stat. And look at the recovery of apartments. We're seeing double-digit rent increases, not just in the fast-growing states like Austin or Texas and Florida, but in almost every market we're in, save one. I think Indiana, Columbus, Ohio, and DC are like high single-digit rent increases. Everything else is double-digit, and you wonder how long. It can't go on forever, but industrial, same kind of thing. We own both of those in our non-traded REIT in enormous quantity, $23 billion portfolio, all high-quality assets, all bought for that environment, rising rents, which we could see because we have so many apartments. We know exactly what's happening and how to tweak our assumptions based on the reality of what's taking place in the marketplace, like turnover. Turnover is a really important stat in an apartment. How many times are people leaving? Do they leave, or they leave every year, or do they stay extra year? Turnover has been falling because people don't want to move. There's no better deal out there. Everyone's moving rents.
Right.
So that saves you, $1,000 per unit per year if the guy doesn't leave or the gal doesn't leave. So maybe it's $1,200 now. So that I think the markets rents are more important than interest rates. So if people feel that rents will move up 7%, you can absorb a 1 point increase in Fed funds, 100 basis points, maybe 100 and a quarter. If the short end were to go to 3%, cap rates would probably back up. And but again, are rents rising because for good reason, because wages are going up and company profits are solid? You will buy down the yield on a property if you can capture the growth of rents. And we've seen some crazy trades in the real estate markets, and particularly in multifamily, because rents are up 20% in some cities.
Barry Sternlicht says rents are more important than interest rate increases. So say you have a 100-unit apartment building, you're charging $1,000 a month in rents. At the end of the month, you're going to collect $100K. At the end of the year, that's going to be $1.2 million, right? Because you're going to multiply this by 12. You increase rents by 10%, that's an additional $120,000 in rents, or $1.32 million. So your net increase is $120K. So if on that same 100-unit building, say the value of it is $10 million and you have a 70% loan on that, so your loan is $7 million. You were previously paying 5% on that loan, and now it increased by 1% to 6%. So $7 million at 5% is going to be $350,000 in loan payments. At 5%, that's $350,000. If you have that same $7 million loan and your rates went up to 6%, now you're going to be paying $420,000. So the spread between the 420 and the 350 is $110K, which is less than the $120K you got from your rental increases. So you're still good. You're still good in a rising rate environment with apartments if and only if you can still increase your rents. Because a 10% rent increase is greater than a 1% rate increase in this scenario. Hey there, I hope you enjoyed the video. If you did, please click subscribe down below and give me a thumbs up. You can reach out to me on Instagram or Facebook at Oliver Fernandez 3. I have new videos just like this one dropping every week. So drop a comment down below and let me know what you want to hear next. Until then, keep growing and keep learning. Just do it.